Hey there, this is Enea. These days, incredible market volatility is a great opportunity to look at the leverage component of out-of-the-money calls, and the explosiveness this component drives in returns at different level of exposures. So to show that and to get more in detail, we will look at two strike levels, one less out of the money and one far out of the money, across two historical scenarios. We're going to look at the recent 12 days plus 29% MSTR price climb and subsequent cool down, and also at the Q4 106% climb that happened in just 21 days. Let's start with the first scenario. So I'm looking at a 300 and a 500 with expiration in December, and I'm looking at how they evolved between the 13th of March until the 8th of April, when the price rallied from 263 to 342. So the 300 went in the money around here, between here and here, but the 500 never went in the money. And the first thing that stands out here is, first of all, the premium that you would have to pay for a 500 and a 300. Oftentimes, like, it varies, of course, but generally speaking, the 500 is around 50% cheaper, which means it would have taken you half the budget to open a position, to get exposure to the returns. But let's look at the returns instead. The returns for the two options, for the two strikes, actually were very similar as the price started increasing. Actually, the 500, who never went in the money in comparison to the 300 that went in the money, performed even better with 65% versus 62% of the 300. Then as the price started to drop, and the price increased 29%, almost 30%, then it started to drop. As the price started to drop, then the 500 started to lower their performance below the 300, but still remaining very highly correlated. And why is that? Why the 500 that didn't even get close to go in the money allowed you to reach in this period better performance than the 300 that went significantly in the money? The answer is explosiveness. Explosiveness per unit of delta exposure. I collected some data and I'm going to show you this explosiveness, but first we can already capture that by looking at the delta and the gamma. So we see that the gamma between the two contracts is actually at the very same level. It's very similar, but the delta is very different. What does this mean? It means that the deltas of these contracts will vary at the same with the same acceleration. So it will vary kind of to the same extent. But what makes the 500 more explosive than the 300 is actually the ratio between the delta and the premium. Now, I downloaded the data and created this table to see how our premiums and our options would have performed with this plus 29% price increase. Here we see that for the two contracts, the premium at our entry point was 50% lower for our 500 call. The profit was percentage-wise bigger for the 500, slightly bigger for the 500, despite the 300 went in the money. And the delta at which we entered was almost half for the 500. And then I created two very important metrics that can allow us to measure explosiveness. So when I say explosiveness, what does it mean? I mean that when the price of the underlying grows, a more explosive option will grow much more than a less explosive option. So your returns will be higher the more the price of the underlying will move. So here I'm looking at the delta to premium. The delta to premium tells us how much directional exposure you get on your option per dollar spent. Here we can see that the 500 has around 20% more exposure. So you're spending half, but you're getting 20% much more exposure to a delta increase. And finally, our measure of explosiveness, convexity. So convexity is calculated as basically the premium percentage change, the profit we achieved percentage-wise, divided the delta that we had at the entry point. Basically, what does it tell us? It tells us how much return we have for each unit of delta exposure. And this is influenced, of course, by the delta to premium. So we see that we have more delta for the same amount of premium for the 500. So that means that when the price will grow, this convexity factor will kick in and will allow the 500 to grow more than proportionally. And we can validate this by looking at the historical data. We see that the 500 has much smaller delta than the 300, which means it has much more room for expansion. In this period, they have same or similar level of gammas, but as soon as the delta of the 300 would start growing a bit more, the gamma would start decreasing. Instead, our 500 would grow much, would would grow much more, which means that the convexity would even increase, and the returns that you would have for the 500 would outpace the returns that you would have had for the 300 by much more. The longer, the further away the price increases. And what happens when the price moves even more? For example, in Q4, I took this interval where the price grew 106% from 230 to 474. And I looked at the same 300 and 500 with shorter expiration. And you see that they increased a lot as well, the premium, but clearly the premium of the 500 moved much more. It reached 2,600%. And when we look at the performance from our entry point to the peak, we actually can spot, first of all, that the 300 was much more expensive, right, than the 500. The absolute profit was bigger, but the premium percentage change was much bigger for the 500. So you would have invested much less and got significantly, percentage-wise, significantly more. We also see that the entry delta was very small for the 500. We had very similar delta to premium to the scenarios that we saw before, still higher for the 500. So proportionally, you get more delta exposure for any dollar that you invest. But the convexity is actually the reason why the 500 really literally exploded, the premium exploded. So the return per unit of directional exposure was 10 times higher. Why? Because you paid proportionally very little to get more exposure to delta at a level of delta that was very small. So when the price started to increase even further, the 500 delta expanded even more than the 300 could. And this led to explosive returns of a more out-of-the-money option. That was it for today. Thank you for following along. And if you want to explore historical option data on Bitcoin equities like MSTR, GameStop, Tesla, but also funds like MSTY and IBIT, I just added these stickers to the dashboard. But also I added the very same feature that I was showing you during the video. So by looking at option comparisons, you can actually compare different strikes and different expirations across time. And you can look at the Greeks, implied volatility, and so on. You can use it to backtest your ideas and validate your strategies. Have a lovely day, everyone.